Jeff, how you doing today?
I'm doing great. How about yourself?
Doing good. Really pumped to have you on the show today. I think you've got some crazy experience and a lot of different stories that we can dive into. And before we do that, you and I sat down at the EY Entrepreneur of the Year Award in Palm Springs. You got a ton of great exposure to the amazing people you work with, and you've been there for a long time. And for our listeners' sake, if you kind of just give us a little bit of a journey through, how you started in there and how you ended up into the VC world that you are today.
Okay, so it's a unique situation and a unique job. So I've been with EY for 30 years. I spent my first 5 years in the audit practice. And the last 25, I've been really immersed in the venture and entrepreneurial world. And so what I do is I kind of have three things that I do at EY. One is I help EY figure out where we differentially invest our time to work with companies. There's a whole host of companies out there, and we can't serve them all. So part of my job is to help find companies that will be high growth opportunities for EY to serve and hopefully take public. Second is do a lot of relationship building with VCs that we do a lot of work with. One thing I'm doing right now and spending a lot of time on is helping connect our large clients who are looking into innovation and figuring out that they can't always invent it in-house, and to figure out ways to get them exposed and intertwined into the venture ecosystem and help them connect with companies that might provide either good point solutions for them to use, good companies for them to invest in, or potentially buy at some point. And then the last is doing thought leadership, what's going on in the venture world and things like this.
Well, and I think that's a perfect tie-in to to setting the stage, because I think, from the listeners, a lot of entrepreneurs, depending on the different size of the companies, what is VC versus private equity versus angel investing, and like all the different span. But from the years of experience you get, can you kind of give us your definition of VC? What is a VC in its truest nature, and where you end up spending your time?
Well, so from a venture perspective, venture investors, their job is to maximize returns for their limited partners. And in doing that, they need to find the best use of their time and the capital that they've been entrusted to deploy. And so typically they're looking for deals that fit a certain profile. And that profile tends to be what they want companies that have a product, by and large, that they've sold into a few different situations, and solutions that have what they call product market fit. So they've got a solution and they understand where they can sell it into, and they've got a semi-repeatable process that they'll hopefully refine over time to where they can sell into companies. And then hopefully they'll tackle verticals, and then they can pick those solutions up and then take them to other verticals with the idea that they can get acceleration and then grow the company over time. Seed situations, an angel are going to be investing more in the product development cycle and where things are near solution or maybe in beta. And some of this there may be some bleed over on both sides. But the situation is such that it's never been easier to start a company from a cost perspective historically. The cost to start these new technology companies has plummeted the last 15 years.
We were actually sorry to interrupt. We were just actually talking about that, because literally you don't need $20,000 worth of servers and a bunch of storage and all that stuff. You can, zip some stuff up and put it all together without, all the capital expenditure that you used to have.
Yeah. And so that has created a very level playing field in a lot of areas where you can cobble together, you can stand up a company on $50,000, which in a lot of regions that's not difficult to come by, and then some people have the ability and the desire to write those kind of checks all the time, and so that typically tends to be more of an angel seed environment, but then those types of investors typically will not be heavily involved in the venture side, and then you start to scale into growth capital, which could entail private equity. It may not, but private equity tends to invest by and large, given that because of the size of the funds that they have. And these people are setting on multi-billion-dollar funds, and they need to deploy hundreds of millions of dollars, if not billions at a time. And that's hard to do in a company that's raised, $50,000 or $100,000. That's got two customers that may have paid them $150,000.
It'd be interesting to see how they spent $500 million if they didn't do that.
Yes, probably not. Well, then you get away from your capital discipline and your nature of being scrappy, and that's not a good thing. So, but that's kind of the hopefully that gives you kind of a flavor for the breadth of the capital markets.
No, it does, because it's important, because we've had private equity firms on the show, also family office firms, and just really seeing the landscape and how everybody's different. I think is just getting everybody's perspective on where they're coming from, and I think that leads into the next question on, so these limited partners. Let's dive into where does the money come from? Who are the type of limited partners? And when you're talking about the private equity funds, they're deploying lots of capital. Where do the limited partners come from? And generally, how are they expanding their portfolio?
So the capital sources for the venture funds are endowments, universities, insurance companies, institutions, large endowments. And venture is a alternative asset class inside their overall portfolio mix. It also could entail private family offices. Some family offices will be, and I know some family offices that do have venture exposure, whether it's direct investment into VCs, into venture-backed companies, or into funds. And so, they're looking to raise so VCs that get a partnership together will draft a offering memorandum. They'll go around to accredited investors. So you're not going to just have anyone off the street invest in this, primarily because they don't have capital, because you're not going to take small slugs of capital. You want, if you're raising a $250 million fund, you're going to want people to do, $25 million maybe, or $10 to $15 million placements. And so, because you don't want managing your investor base, just like an entrepreneur thinks about managing their cap table, venture capitalists need to think about managing their cap table. And the other thing is, the accredited investor nature of it. You need to have, it comes from sophisticated people who have, this is risk capital. So you have to have the wherewithal to be able to put this capital in a high risk asset class that you won't see for 10 years, because these partnerships agreements are 10 years long. You can extend them, but this is highly illiquid capital that's put into high risk ventures with the idea that you are going to get very high returns for the differential risk that you're assuming.
Mm-hmm. So when you have, let's say you've got a bunch of limited partners that have, aggregated, and they've got the 250 million or whatever, the funds that they want to deploy. How do they, because I know like a lot of private equity funds, whether they raise a $300 million fund, or they've got a couple of them that get into the billions, they have a handful of companies that are, mid-market, healthy, mature companies. In this, is there a certain amount of companies that they like? Because is there a certain, it's kind of like gambling, right? To a certain extent, where they place their money in all these different companies and they expect, a few of them. What are kind of the ratios, and what are the expectations that they have for how they deploy that?
Well, everyone's got a different strategy on how they deploy capital. And that's part of what limited partners are going to look towards and help evaluate who they deploy capital to. So there's no standard playbook, but they are going to invest, depending upon the nature of the size of the fund, you're going to invest in X number of companies. Because if a company raises a $5 million round and it's syndicated between two funds, so each puts 2.5 in, you're going to need to reserve a certain amount of capital if you're going to take additional positions. Because one of the strategies that you want to make sure that you do is, as a venture investor, you want to maintain a certain percentage, typically, of ownership. And so the $5 million is not going to get you to the finish line usually, because it always takes longer and more money than you ever expect, which is one tip for entrepreneurs. And so you're going to want to maintain that prorated position. So you're going to want to be contributing in downstream rounds. So you're going to need a reserve. So you'll need to map out how much money you have, how many deals you think you're going to do at what size, account for reserves, account for salaries, et cetera, and kind of do an entire budget and work backwards from that.
Well, which is interesting. What is the the percentage that most people like to reserve?
Well, a percentage is hard to say. What I would say is that, if you're going to put, you're probably going to put, most funds are probably, you're probably going to think you're going to put, depending on the size of the fund, anywhere from you're probably going to put $10 to $20 million to work in a deal, give or take. Could be more, could be less.
Well, and the percentage, I'm assuming, changes as the different potential partners or people pop up, and you want to make sure you're maintaining the level of involvement that you want in that specific deal.
Yeah, and depending upon what kind of fund you are, sometimes you may just decide if the deal is incredibly highly valued, and the valuation just keeps going up and up, then you just ride. The value keeps increasing for you. Your percentage of the ownership may actually decline, but the pie gets so much bigger that you're fine with that. So it all depends.
Got it. So let's dive in a little bit to who are the limited partners and how to, because when you and I were talking at the conference, it was, some of the main things that we want to kind of dive into is, as an entrepreneur goes out and is picking, a VC to partner up with, there's a lot to take into consideration. So not only do the ventures that are out there deploying to specific deals are looking for things, and I think that's a whole episode in itself, but it's also when you flip flop it, as the entrepreneur is looking to raise the money and looking at the different types of deals and the different types of partners, what is the involvement and what does the kind of the process look like as the different types of partnerships that are out there?
Well, so from an entrepreneur's perspective, if I was to raise money, or if I was to work with an entrepreneur to talk to them about how they're doing it, what I would say is you need to understand who is doing the types of deals that you are. So if you're a software company, who does software deals? Or if you're a software as a service company, deploying your solution as a SaaS solution, who does SaaS deals? And knowing who they are, because they've got expertise, they're going to understand these general markets, then also know what deals they've done, understand who is in your ecosystem, and you don't want to approach somebody who's done a competitive deal. And it doesn't matter that you may not think that they're competitive to you. If the venture firm thinks that they compete, then that's the definition of competition. Because then you're going to spend all your time trying to convince them that you don't compete with their investment, and not talking about necessarily what you do and how you can help make them money. But then you look for opportunities. Then you kind of come up with a short list of people of, who do you think for whatever reason makes sense to invest in your company? And that could be from an individual partner perspective, where they sit in the ecosystem, what they can do, a whole host of things. And then I would put together a target list of firms that you want to approach.
Well, isn't it so interesting too? Because when you think about, there's a lot of capital out there that wants to be deployed from a lot of these different big institutions, and which we can talk about in a little bit. But as the entrepreneur coming from their perspective, is like finding the money, whether it's smart money, dumb money, whether it's strategic money. I think there's a lot of different things to think about, because getting $5 million to build your payroll and do the R&D or whatever it is to deploy it doesn't mean that they're going to necessarily provide value to you. In that, is that what you're referring to, the ecosystem, as like how you can leverage their talents or skills or whatever it might be?
Well, from a venture partner perspective, these part of their job is to, it's not just money. It's also all the other things that they can help you do, because at the end of the day, they're supposed to help grow these companies. So they should, Dave Hornick wrote an interesting piece on it, that was linked on his Twitter feed the other day about what makes a good board member and good activities of a board member. I thought it was interesting just because, he talks about making yourself available to provide insight and help, because, a CEO's job, when you think about it, is very, at a startup company, is very lonely. You are the person, you are the man or the woman who's the weight of the world of that company is on your shoulders.
And now $15 million.
And that can be a very lonely position. And so you need to have others that can help you, be resources to you. And a lot of people look to you, but then, so on top of the capital and the fuel, it's, we're trying to sell into XYZ company. I see that you know people there. Can you help me get connected? Because we're having a hard time finding the right person, helping recruit people, helping close people to come to work for them, providing candidates, a whole host, a litany of things around how you help build up the corporation and how you help build the business, and that time into the company accretes back to them in an increased valuation.
Well,
and so
that kind of goes into one of your first comments about how you spend your time, because you can leverage time with those kind of connections, and that those are significantly valuable if they line up with the right, the VC lines up with the right, business or right deal.
Yes. And return on time is a huge, time is the one resource that we all get an equal amount of.
168 hours a week.
And it's non-regenerative. So once it's gone, it's gone. And so how, finding people who can help you maximize that and create value. Because money, like you said, money is money, but sometimes you might just need money. I mean, this is all situational too. If you truly need cash early on, but thinking about how you finance your company, I guess stepping back, you want to keep it moving forward, and having people who have been there, done that on the team, and making sure that there's room for them on the cap table. So each time you go back and raise another round, that there's plenty of room for additional people to add value versus just taking large amounts of money from people who may not be able to add any value, or who won't stick by you or won't be by your side when things get a little dark.
Well, I'm sure with your experience, you've got a couple stories that come to mind in a scenario like that. So maybe if you want to toss up a story that, a short story on someone that you've seen do it really well, maybe someone that you've seen kind of go south when the pressure got on.
Well, so when we think about that, professional investors have a tendency to, this is in their job description, and things don't all, and every professional investor's got examples of situations where things worked out really well and things didn't work out so well. And that's the nature of their business. Because in reality, most of the time, it's probably not going to go well, because they're kind of in the business of outsized returns.
Right.
And nothing ventured, nothing gained. That's why it's called venture capital. So you can figure out, who, when you think about who you line up with, there are, everybody clicks with different people for different reasons. And so even inside, an investor base, you're going to find people that you may more naturally have an affinity for over others who can provide certain things. And that would be part of your decision-making process in terms of who do you approach and who do you target to get into your company. So, because we don't really talk about, horror stories, and everybody's got them, but,
Well, and I think, instead of necessarily talking about a horror story, I think it's about, one of the biggest things that I don't think people think about until afterwards, which is kind of the whole start, build, grow, finish, exit. And it's how that partner is going to be involved in all parts of those, because you're just as married as with them as you are with your spouse. And probably more so. I would agree with that, right? So, 100%. And so how you're picking that partner, whether you're clicking with them, there's the strategic value that they got, but how they interact in the decision making, I think, is important. And I think that's a lot of things that happen in the PE world, where they don't realize who they're partnering up with, and whether it's micromanagement or no oversight. And so when you think about that whole journey as the entrepreneurs partnering up with the VC and working with them, what are some of the key decisions or the questions that they need to be asking about, whether it's when something goes wrong, how do they deal with it, when and how they exit? I mean, what are the things that they can do what kind of questions do you think that they should be asking along that?
Well, if we're talking about evaluating, it's talking to people. The interesting thing is today, information is widely available compared to where it was 15 to 20 years ago. So it's talking to others who have worked with them and understanding. Almost kind of doing kind of reference checks on people that you're wanting to do business with, or and part of that could be in the approach process, because you're going to hopefully try to find somebody who can make an introduction to somebody, and in that introduction process, you can ask the questions around, so what is it like? Because that is a great way to get in front of somebody, is to be referred into by somebody who's known to them, and you can kind of figure out what it will be like to work with them. One thing is that, it's also how you handle bad news as well, and how you deal with it and how you present it to your board, because the board never likes to be surprised.
Mm-hmm.
And so even if things aren't going necessarily great, you're probably going to be rewarded well if you keep the board apprised and keep them ahead of the curve, rather than feeling like they're being told about bad news after it's occurred or after it's too late.
Well, I think you hit on a really important topic, because, I think a lot of entrepreneurs, their biggest fear is, they had this idea, they birthed this baby of a business that's going to be out into the world, and who they're partnering up with, how they're dealing with the problems. And the biggest fear is Travis with Uber, understanding, like, I can be ousted from the company that I started, or the jobs, or all these different, the big stories that everybody's heard of. How do those situations come to be? And then how do you protect yourself if you're the entrepreneur? And then what are ways that you can mitigate that situation?
Well, I think it's one interesting perspective is to have everybody looks to a handful of icons who started their company, took them public, and are still either CEO or chairman today.
Mm-hmm.
And there's only a few of those people.
Right.
And there's 18,000 plus startups in the United States today. So most entrepreneurs won't end up there. And that's not necessarily a bad thing, because, do you really want to run a company of 20,000 people? Yeah. And so everybody's got a different passion. And so, but it's figuring out how you lay that in and work with your investor base, over time to grow the company. And your interests are aligned when you're talking about trying to grow the company and create value, because, you as the founder have equity in this company. And so whether it's you getting it to a certain stage and then, taking a chairman role, or taking, maybe your passion is product development and somebody else needs to come in and take it to the next level. Is that necessarily a bad thing? Not necessarily, as long as value is continued to be created for everyone. Then it's hard for, having never been an entrepreneur myself, so it's easier for me to have that perspective after having not gone through that. Because at the end of the day, I think everybody's trying to make sure that something's bigger and better at the end, when the ultimate time for exit is, such that, everybody's walking away with something for all the hard work and the risks that they took.
Oh, I think that was very well said. And it's a degree of self-awareness. And I don't know how many people or, entrepreneurs or deals that have been blown up, because how often do you see that the entrepreneur has unrealistic expectations of becoming Jeff Bezos or someone that's running this company, and doesn't realize where they fit into the storyline as the company grows? How do you guys, and how do people deal with that?
That's something that, the board has to, that's one of the things that would fall under the board's purview. And it's about, giving the CEO, giving him some feedback on how things are going, because part of the job is, hopefully the founder is growing, because they're going to learn a lot. Founders are going to learn a lot going through this process, and you don't always get it right the first time. And most founders are serial founders. So and what can you pick up and what can you learn, and what do you not do again? What do you do differently the first time that the second time that you didn't do the first time? So it's kind of, go ahead.
What I was going to say, what do you think the biggest mistakes that entrepreneurs make as they're going through this process? Is there like a couple that you see that are common, trends that you could kind of almost see them coming because they happen so often?
Well, I guess the two things that we see consistently is, and it's not, you really can't fault anybody for it, but it always takes more time and more money than anyone ever anticipates. And it's for a variety of reasons, but one, part of it is, how quick product adoption happens. But when a lot of times when these deals are being pitched, it's all blue sky. I mean, these are markets that will evolve, and investors and entrepreneurs think they know how the world is going to evolve, but then life starts to happen, and other competitors enter the market, and people find out that, oh, it's not as useful. They didn't like it for X necessarily, but they may have liked it for Y, for a different solution. And so that's when you start to get real feedback. And that's the art of entrepreneurship, is how to deal with all that feedback in a real-time basis, and process it all, take it all in, and continue to push forward. And the analogy we use, it's kind of like when you leave San Francisco to go to Hawaii sailing, it's not a straight shot. Mm-hmm. The art of sailing is tacking, and it's going back and forth and catching the wind. And sometimes the wind's gonna die, and you're gonna have to tack and figure out how to pick up the drift to keep you moving towards Hawaii, even though it may not seem like you're moving towards Hawaii.
Well, I think that's a great analogy too, because I mean, who you're sailing with are the people that you need to be on the same level of communication with. Because if you're not communicating, there's no way you're going to actually get there, because it takes a whole team.
Yeah, and then if your time horizon is off, typically, you're spending cash while the time extends. So it typically takes more money, and then there becomes a time at which point you think that there may be optimal time to turn up the energy, and so that requires typically a lot more cash.
So how do people go about that situation then? If they're communicating most of the time, they're probably it's probably closer to a non-event. But, is there certain breaking points where you see people shut down the deal because it's just, there's no, sight in mind, or there's no light in sight? Or like, how do they go about actually making those decisions? Because if it's a 10-year time horizon, that gives you quite a bit of leeway. But how do you deal with the time and cash horizon?
Well, in a specific situation, a lot of times what you'll find is, it's time to raise your D round, so to speak, and you've got your other investors in, but you'll need to find a new lead investor. And the inability to find that new lead investor would be a trigger to say, okay, well, we either need to sell the company or shut it down. If we can't find anybody to buy it, we'll need to shut it down, just because we've reached a stage at where, okay, for a variety of reasons, we're not going to continue, because we may have hit the spend that we thought we were going to spend, and we need somebody else to help validate what's going on or help spread the risk. Got it.
And let's shift gears a little bit, because I want to make sure we talk about it for a little bit. Is, as we looked at, where these funds are coming from, you mentioned at the beginning from the endowments and the universities or insurance companies and such, but there's this new kind of wave happening in corporations that you and I have talked about, which I think is very interesting, because it's something that's different for them trying to hit the returns. But can you explain a little bit how corporations are getting into the VC game because of kind of the market landscape?
So we've spent a lot of time talking to some of our large clients about this, and I've done some work for some of our clients on deals. And it's not so much the big trend that we're seeing is the tech enablement of industries. And so you look at it in financial services, healthcare, insurance, transportation, logistics. There's a lot of things going on that are being tech enabled. Mm-hmm. And so as a response to that, we're finding that some corporations are saying, okay, we may no longer be able to innovate as effectively inside as entrepreneurs can outside. And so what we may do is raise up our head and decide to look around and look at what's going on outside our four walls. And they find that it helps give them a greater perspective on what's happening. And in a lot of cases, it's a better approach to take, because it's better to look around to see what's coming, as opposed to wait for somebody to show up on your doorstep and show that they can all of a sudden, apply technology in an innovative way and take a significant piece of margin out of your business. Mm-hmm. And so go ahead.
Well, I was gonna say, does that follow the kind of the philosophy? You're familiar with Peter Diamandis and the exponential organizations, where these big companies are buying these, incubators and leaving them away from the mothership because it's so difficult with the bureaucracy of some of the bigger companies, and they're trying to almost develop the company that could put them out of business, like the blockbuster starting like a Netflix almost or something like that. I mean, is that kind of what you're seeing, or is it more just about staying in line with where their current business is, that they're just kind of slowly venturing outside a little bit?
A lot of it depends upon the nature of the organization and what their DNA looks like. But, a lot of times it can be a mix of, we will get some financial return for this. It will be, we can maybe find commercial deals that, technology that we can put into our product. Maybe it's technology that we can sell. We've worked on some deals where there's been side arrangements where our client's investing in technology, and there's also, they're going to sell the product through a dealer network that they had. And so we think we get a double lift, and, and maybe something we might ultimately buy. If it becomes very successful, maybe we may want to buy this thing, or we may not. It may just give us exposure to what's going on into an evolving area, and it just gives us better visibility into how the world is developing. And so it's a mix of those. It can be a mix of those things, and it depends upon the overall strategic, the nature of what the initiative is being pushed forward based upon. But I mean, typically what we see is, and to be successful, I think what corporations need is a kind of a twofold approach. Is you need somebody who understands what the wild looks like, who can go out into the wild and has been out in the wild and has done deals and has seen technology and has worked with entrepreneurs. But then you typically need to pair them with somebody who knows how to navigate the ecosystem inside the corporation, because a lot of stuff can be brought back in and killed. And so I had a friend who had that problem back in the late 90s, early 2000s for a very large global conglomerate. And he would come out to Silicon Valley and he would find all this really cool stuff, and he would go back, and he was headquartered he was in Europe, and he'd go back and nobody wanted to see it because it wasn't invented there. And he became very frustrated by that. And so having kind of an outside-inside ability, because you can help, getting good deal flow is a critical success factor of any venture investor, whether you're corporate or institutional. But if you're, navigating the internal organization, if you're being brought in from the outside, can be very difficult because you don't have the history. And having somebody who knows the history of the organization and what's been tried before and who sits where and where the bodies are buried and who put them there is important.
Well, I do. And what's really important about all the stuff that you've kind of explained here is, for an entrepreneur to actually successfully go through the intro, start, grow, exit phase, knowing all the stuff that you just talked about is crucial, because you're understanding the motives of the buyer. And I think, in my perspective, there'd be a heck of a lot more successful partnerships if you understood why these buyers are doing, or all the partners are coming in and doing this stuff, because then you will have a pretty good self-awareness of what the end goal is, instead of just navigating yourself, trying to go, steer yourself instead of to Hawaii, completely over to New Zealand or something like that, because you've got at least the same compass in where you're going.
Mm-hmm.
So as we kind of shift this around a little bit, what are the actual physical ways that people go out and they actually do these introductions? Are the VCs out there cold calling, or is it networking? If you're an entrepreneur, to get partnered up, like, what are the actual ways that all the commingling actually happens?
So VCs are out speaking at events. They're out attending events. They're very public in their profiles in terms of, web pages, and, most people know how to get to them. What venture folks are looking for are kind of curated deals. So from their network of people that they went to school with, that they maybe have funded before, they're looking for introductions. And so it's trying to find, and so when you look at the ecosystem, there are people that will help make introductions, and that can be people that they have funded before, people who have been successful entrepreneurs before, service providers who work with them. So we make introductions. If we think something's interesting, there may be opportunities for us to make introductions. Bankers, the bankers that work closely with the venture people and help provide venture debt and other things are good sources to make introductions. as well as attorneys. Attorneys that a lot of times are sitting in, acting as secretary or sitting in the board meetings with with venture investors on other deals, and so they're in close proximity to people who are looking for more deal flow. That is qualified, that is some degree of qualification. Because the challenge is how do you wade through everything that's out there?
Well, yeah, and like kind of the ecosystem you keep referring to is you're also really vetting the individuals too. So it might be a great idea and all this, but I mean, you got to figure out what degree of crazy is this person that's bringing this deal to you. So if you can vet them out through like the created ecosystem, you're as a VC, you're mitigating a lot of your risk because you've got a lot of people that are vouching for you.
Yeah, and somebody's not going to, because of the way it's kind of like an unverified Yelp review. But if I send off 5 crazy ideas to people, they're going to stop answering my emails. So right. I have to have a degree of conviction that something's going to happen, as does anybody else who passes it along, to say, hey, it's worthwhile, and to have somebody take a look at this.
And do you think that those situations like you just referred to, are they more successful if someone has an idea that says, hey, here's the few companies, here's what I think, here's why I would be a good fit for that, like literally looking way down the horizon? I mean, is it too bold to kind of be that presumptuous, or is it more beneficial because they've got a little bit more foresight?
I'm not sure I understood, but
so if an entrepreneur like sent out a little note that says, hey, you know what, here's my idea, I've got a lot of conviction, here's what's going on. But if they took it a step further and said, hey, this is, I believe, the potential exit options, or the people that the buyers, or here's literally, a couple steps in advance. I mean, is it almost laying the map out even a little bit more? Would that be something that would be more beneficial, or do you think it would be too presumptuous and potentially hurt the communication line?
I don't think it's too presumptuous, but I don't know if it's necessary, because you don't know how things will. You don't know if that's the way the world will develop. That's the assumption. Mm-hmm. But if you can paint out a picture that says, we think we can provide a solution that solves this pain point, and we know that, and we've got 3 customers that have bought it, then that gets their interest, because, if you're solving a high value problem, there's probably many more people out there that will pay for it. And then what you spend your time doing is finding out ways to get very targeted introductions, as opposed to a cold call or an email drop into somebody's box. You try to get somebody to share the opportunity with them, and seeing if there's, and on your behalf.
Yep.
And I think that's more powerful. And then, and making sure that you communicate that there is a huge market out there as well.
Right. And I think that piggybacks into one of my last questions, is you and I had talked about, there's like this sliding scale from, you got the angel investors that are looking for the R&D, the seed rounds that are really just trying to get something off the ground. And then in the VC world, there's this narrow spectrum in my mind. And then because you and I had talked, where then eventually you get to the point where you could get different types of financing, whether it's from a PE firm or a family office or whatever, where, how in like the operational maturity of the business, or where, because you get, like you keep referring to the people that have got some customers, they've proven that there's a problem. What are some of the criteria that in that spectrum that you would really like to highlight?
Well, not every deal is a venture deal. Venture deals need to be companies that have the potential to deliver outsized returns if everything works the way you think it's going to work. So opening a coffee shop, on the corner of your hometown is not necessarily a venture deal. Opening up a global coffee chain maybe is. So, size of scale. So it's understanding where it fits in that. And private equity deals are typically going to be put into companies that are already operating companies that are typically generating profit. So they're EBITDA driven, profit driven, where you can do carve outs of divisions or very interesting things that may have a lot of financial engineering around them. Whereas venture deals tend to be deals that it's kind of brave new world, and it's better, faster, cheaper, but it's better by a factor of 10 or 50 or 100, and it's faster by 100.
The fact that everything's not a venture deal, and again, it's kind of the difference between the coffee shop and the Caribou Coffee, and the way different. It's the big idea, and I think Jeff, with your spectrum and your oversight of how much you see, can you kind of give us a little bit of the market overview of what you're seeing? What are the big ideas that are out there? Because I think you mentioned that the tech-enabled industries are disrupting a lot of things, and I think a lot of people see that. But where are the big ideas coming from right now? What are things that people need to be looking out for, or where's the movement happening?
Well, if I knew that, if I knew that, my wife would be much happier. We'd be living a much lower stress lifestyle, et cetera.
And you would not be talking to me.
I'd still talk to you, but
For sure.
But that's why I tell my partners, it's like, because I was asking, was this going to be like the next big thing? I'm like, if I knew that, we wouldn't be having this conversation. I'd be calling it in from the beach. But I think the trend on tech enablement, that has a huge tail. And I think that reaches across the country, because I think you're going to find there will be people in the next several years who find ways to apply technology into businesses that dramatically drop cost and take significant costs out of business, enhance margins, or just drop prices altogether. When you look at, EY is looking at the application of technology in our business. We're taking a serious look at that and figuring out ways to take analytics into our audit practice and provide much greater transparency on trends, much greater analysis in a much quicker time, and in a way no one ever could, probably.
Mm-hmm.
That's just one example. You would think that we would not be, besides buying laptops, you would think that's all we would be doing. But no, we're looking at that because we think that is the future of how we deliver our service. And I think there's numerous industries across the U.S. and around the world that can reap the benefit of that, especially when you start thinking about, all the, and sounds a little cliche-ish because I hear it a lot, but all the data that gets thrown off from all the digital footprints that are being made every time a keystroke happens, and how you take that, compile that, parse it, and make sense of it, compare it, analyze it, and deliver a better solution.
And that's every industry. Like any, yes. And what I find interesting too, if we're just, as we're talking kind of global, technology trends like this too, because I see this whole wave of baby boomers that are going to end up as they're looking to exit or sell their companies, but there's the technology disruption in every industry is so huge that where the value is placed on different industries and different companies is going to be so interesting to see how it all comes out, because someone could create a software platform, like you said, for $50,000, and they can create an entire ecosystem of inventory that already exists, versus because they got data, versus the service distribution models that are very prevalent in the US right now. Where is value in a digital environment, in a rapidly growing, enhancing digital mobile first environment? Where is value? And how do you, and thinking about it in that realm from an entrepreneur's perspective, and how do you capture value through a solution that companies can't live without? It's really interesting. Have you ever read the book Platform Revolution?
I have not.
It's a fantastic book that kind of talks about the different kind of way, like it kind of dives into the value and where these platforms are creating value and the different KPIs that they're measuring value on. Because in the digital world, there is no inventory or lack of inventory, because it's all abundant. So you can race to zero marginal cost crazy fast. And it's kind of an interesting concept when how do you you project out future value, and potentially you could be racing to zero instead. Or
zero cost,
right?
100% margin.
Well, yeah, exactly.
Yeah.
It depends.
So,
right. But what I was going to say is that it depends on, again, if someone else comes out with another $50,000 platform, they could undercut you. Where it's like, what business is Amazon in? Because it's all about where their profit center is, and what else can they give away, because they had zero marginal costs in other areas.
Well, because they understand they have such such exposure to you across so many different aspects of your life.
They've got the data.
Mm-hmm.
Well, I really appreciate coming on the show, Jeff. I mean,
thank you.
All the different pieces that we talked about. If there's one thing that you were to leave our listeners with that we either talked about, they didn't want to re-highlight, or leave them with, what would it be?
I think that a couple of the points I made is it always takes longer and more money than you ever anticipated. And it's not because, and people are always optimistic, and they wouldn't be optimistic. You can't not be optimistic to be an entrepreneur. So, but it's building in some cushion around that is helpful, because it gives you more runway from a finance perspective and a time perspective.
And being aware of that and how you communicate is huge. Yeah, I agree. Thank you so much for coming on the show, Jeff.
Thank you very much, Ryan.